Is Cathie Wood's ARK overvalued? Over the past few months, more and more investors have been claiming that Cathie Wood's investments have climbed too high, too fast. In fact, one of the world's most respected investors for predicting crashes, Michael Burry, recently revealed that his firm today are shorting ARK. In other words, the man who bet on the '08 housing market crash before anyone else is now betting on Cathie Wood's ARK to fall in value. So, who's right? Is Cathie Wood right? Or has Michael Burry called it correctly again? In this video, we're going to hear from both sides to try to answer those questions. So back in June this year, Michael Burry tweeted to say, "People always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things by 2 orders of magnitude. Hashtag Flying Pigs 360. So the famed investor has been vocal in sharing his opinion that inflation is coming, potentially even hyperinflation, and his investments come as a direct consequence of this belief. So what happens if inflation does continue to rise? Well, if inflation rises too sharply, the Fed will likely have no choice but to raise interest rates and cut back on quantitative easing, which we've seen recently. Now, if all else is equal, the biggest losers of this would be the companies who are trading on high valuations today because of the great potential they may offer in the future. In other words, the investments that Cathie Wood holds with her firm ARK. So in simple terms, it appears that Michael Burry believes inflation is coming, and so he plans to profit by shorting ARK. However, Cathie Wood doesn't quite agree, naturally. She has a few counter arguments to share, so let's hand it over to her now.
Ark Invest founder and CEO Cathie Wood joins us here on Tech Chat this morning. Cathie, always good to have you. Thanks for the time.
Thank you for inviting me, Carl. Always happy to be here.
So let's talk about the short community at large. What is your message to them right now?
Well, you know what, when I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little more comfortable. I like bad news and maybe news that's not, the discounting is worse now than the news actually will be. I actually feel better in that kind of environment for our strategies. I don't think we're in a bubble, which is what I think many bears think we are. In a bubble, and I remember the late 90s, our strategy would have been cheered on, rah, 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 go get them, right? And you remember the leapfrogging of analysts making estimates, one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or SPACs coming out and falling to earth. We couldn't be further away from a bubble. And the reason for that is the innovation around which we have centered our research. These 5 platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, are barely off the ground. The seeds for all of these platforms were planted in the 20 years that ended in the tech and telecom bust. And ended in tears, and there's a lot of muscle memory around that. But that's not what's going on right now. The seeds planted back then are beginning to flourish now, and it's just beginning with 5 platforms involving 14 different technologies, all of which are about to experience S-curves and feed one another's S-curves. I don't think the market's ready for this. That's what I meant. We've dedicated our research and investing to innovation because we think we've never been at a more provocative time for innovation in history.
And I do want to get to how some of those forces are playing out on your macro thesis, which you've talked about a lot in recent months. But as far as the shorts go, in terms of how they have their eyes set on ARK specifically, is it just, do you think, is it general macro bearishness, or does it have something more to do with your ability to analyze all these companies that you're now in and stay on top of that game?
I actually think it's more of a macro call. when I read the bearish analyses, they seem to be centered on inflation and interest rates going higher, which will kill valuations. And if anything, as you mentioned, Carl, we're focused on the deflationary forces that are building up in the economy. And I think that's going to be the shocker out there, that deflation is the greater risk now, not inflation. And not all deflation is bad. There's really good deflation associated with these technologically enabled platforms. They follow learning curves, which are characterized by declining costs and prices, and enables more and more sectors to have access to these powerful new technologies. So that's good deflation. The bad deflation is going to be associated with companies who paid too much attention to short-term oriented shareholders who wanted their profits now, wanted their dividends now, and did not want companies to sacrifice short-term profitability in order to capitalize on some of these massive trends that we see building. They are going to be stuck with obsolete products, and yet in the meantime, they've leveraged up their balance sheets to buy back sales and satisfy short-term oriented shareholders. How are they going to service that debt? They're going to have to cut prices of these products and services that are not going to be as popular in the future as they have been in the past. And then the third source of deflation, which is really starting to come through now in a noticeable way, started in mid-May, when lumber prices broke. We're seeing commodity price deflation. We've gone from, lumber prices have been cut to less than one third of their peak, 1711 to 500 right now. You've got copper down roughly 15%, 15 to 20%. You now have oil down nearly 15 to 20%. And I think the cream of the crop here, and the reason this may be happening and may accelerate to the downside, is the dollar is going up. And that, of course, might be associated with what's going on in China.
Right. And Cathie, a few moments ago, you talked about the innovative way that you guys at ARK structure your research. And I wonder, what does someone shorting ARK miss about your approach, the advantages or perhaps the differences of being an ETF versus, say, a hedge fund?
I don't think the wrapper matters that much. I think our research is the differentiator. And the way we've set up our research department is a differentiator. Unlike traditional asset management firms, our analysts do not follow sectors. They follow technologies, the 14 different technologies that I mentioned involved in these 5 major innovation platforms. So they are technology specialists, and they are generalists when it comes to sectors. So we have a very good idea based on our analysis of these technologies and Wright's Law. Wright's Law, we've centered our research around it. Wright's Law is a relative of Moore's Law. But Moore's Law is a function of time. Wright's Law is a function of units. And Wright's Law has worked better in the semiconductor industry recently than Moore's Law has. So we think that's a very important gauge of how quickly these costs are going to decline over time. And we also pay a lot of attention to price elasticity of demand. At what point in this cost or price decline trajectory will new sectors open up to these new technologies? And so I think what we are able to see is our exponential growth trends that are not priced into the market. I'll give you the easiest example. Last year, EV sales were 2.2 million units around the world. We think, based on the declining costs of battery pack systems, that electric vehicle prices will drop below gas-powered prices in a year or so. They're already lower from a total cost of ownership point of view. So we think that 2.2 million will be 40 million in 5 years, in 2025, not even 5 years. No one is forecasting that. So the starting point from the top down, using Wright's law, getting a sense of how quickly the costs associated with these technologies are falling, and how quickly, therefore, they will be taken up by more and more sectors and industries over time.
So Cathie highlights several key points. Firstly, the bond market appears to agree with Cathie, not Michael Burry. Secondly, commodity prices such as lumber may have seen a rapid growth in price earlier in the year, but they have subsequently fallen sharply. But most of all, the main thing that Cathie believes short investors are simply missing is that the 5 technology platforms she focuses on span across numerous different industries. So while traditional analysts may focus on an individual industry, at ARK they recognize that technology like blockchain or artificial intelligence will have wide-ranging applications across virtually every sector in the coming years. As a result, you can't apply traditional sector metrics to value a company that doesn't operate within just that sector. A company like Tesla, for example, you can't value them as just a car manufacturer, because it is also an artificial intelligence chip company, a battery company, a robotics company, an energy company, and even more. Now, of course, there will be a fair value for companies like Tesla, but the key point is that we have to include all of those elements when giving them their value. To say Tesla are just a car company would be wildly missing the mark, and yet that is exactly what so many traditional analysts today are doing. So those are Michael Burry and Cathie Wood's thoughts, but I'm interested to hear your thoughts. Do you think Cathie is right, or do you think it's Burry that will have the last laugh? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.